So today I'm going to talk about one of the hot topics out there. Is there going to be a stock market crash in 2023? And is there going to be a recession as well? So I'll give my opinion on it today. And as always, I'm going to say this straight up. I talked about this about 2 weeks ago about is there going to be a 2023 stock market crash? And I want to make it clear, I don't know. And no one knows. No one knows exactly where the stock market is going to be in 12 months' time. No one knows where the economy is going to be in 12 months' time. We can all make a guess, we can all make a prediction, but generally anything can happen in 12 months. There'll be events that happen that you aren't able to predict. Something happens out of nowhere and that changes the whole picture. So right up from the start, I'm going to say I have no idea what's going to happen in the next 12 months. But if I was guessing, this is what I think could potentially happen. And also I get asked quite a bit, what will this potentially have an impact on the stock market or the economy in the next 12 months? I'm going to give all my thoughts on this, and I'm going to give my opinion today on if there was to be a crash, if there was to be a recession, what potentially could be the main causes of this, and what is for me at the moment the worry out there. What am I worried about going into 2023, and what potentially could see us unfortunately hit a crash or recession? So for you guys to ask this video, hopefully it sums it all up for you and things to keep an eye on. So 2022 was a rough year. It wasn't an economic disaster, but it wasn't great either. And the stock market wise as well, it wasn't a good year in the stock market because there was a few pressures out there. First of all, logistics were not great in 2022, although they have started improving, so that's really good. We had the dollar being very strong, that hurt a lot of businesses, but that has improved as well recently. So these two problems are looking pretty positive actually moving into 2023. Inflation obviously went a lot higher than what was forecast and predicted. That has started coming down quite rapidly at the moment, but still has a fair way to go. And it probably, once again, we don't know. This is the thing. We should see that come back down to a good rate in 2023, but that is up for debate and we'll see what happens. Interest rates are being caused to go higher because of inflation, and at the moment we look like interest rates will maintain being pretty high in 2023 until we see inflation come down. Now that's going to be an issue I think in the next 12 months, which we'll talk about in a second. Next is Russia and Ukraine, a event that was very much not predicted to happen, and it happened. That obviously caused a few problems out there for a lot of economies and a few supply chain issues, oil prices. So that's a problem that is still continuing to go on, although I don't think it'll have as much impact on a company's financials in the next 12 months. China and locking down. Without doubt, China, one of the big world economies that keeps opening up, locking down, opening up, locking back down, has caused some of the inflation. It has caused some of the logistic issues at the moment. So we'll see where that balances out in 2023. Obviously, they look like to be calming down a little bit at the moment, but with China, I wouldn't trust them. I would not trust them what they're going to do next, so we'll leave that one there. So actually moving into 2023, a lot of this year's problems look to be resolved or not be as much of an issue. But there is one big pressure that I think is going to move into 2023 and could potentially cause problems. Now this, funny enough, can actually be controlled. We can eliminate this factor overnight. However, it's probably not going to happen because unfortunately we've got inflation, and to bring inflation down you need to obviously higher up the interest rates, and that is probably the main issue for me going into 2023 is interest rates. Interest rates are the highest they have been since the Great Recession, and that is an environment we've not been in for a very long time, and it looks like this isn't going to be resolved for quite a few months until inflation comes down. And then there's also the worry on interest rates are potentially, even though they can be controlled and be reduced overnight, the issue is that could these interest rates potentially overhang very too long by the people that control them and push us into recession rather than looking and reducing them interest rates a lot faster, because this is a massive change of environment on so many people. If you look at consumers, it's going to affect consumers, it's going to affect businesses massive, because interest rates are going to first of all affect income. They're going to affect the everyday person that has the disposable cash to go out and spend on the economy, and the economy does absolutely amazing. If they have something that is going to be impacted by interest rates, big thing at the moment I'll say is obviously mortgages. mortgages, you have a mortgage that was at 2%, and if you've locked in at 2%, well done, because obviously you look at that now and it was an absolute fantastic rate. If let's say your mortgage expires and you have to go get a new mortgage, and that new mortgage is now going to be at 6%, and let's not forget house prices are miles ahead of where they were in, say, 2008, the miles higher in 2022. If you're now going to go get a new mortgage and your interest rate has gone from 2 to 6%, you're going to be paying a massive amount out every month than what you expected. You're going to be talking hundreds of pounds or dollars of your disposable income gone. And if that is happening to more and more people, and the longer that goes into 2023, because as you think about it, in 2023, more people's mortgages are going to be expiring. They're going to be hundreds of pounds or dollars worse off. And you're going to see that in the economy. People going, I can't go spend as much as I was doing a year ago because I've got a mortgage now that I have to pay X amount of extra money on, and I can't go spend that on so-and-so. You're also going to see that from a point of view of anything else in terms of loans or anything like that. And the longer these interest rates stay higher, and the more people it's going to, drag into that category. I know personally for me, I've been quite lucky. I've got 2 mortgages and both of them are locked in at 2% for 5 years. So I'm all right for 5 years at the moment. Well, technically one of them's 4 years, the other one's 5 years. I'm okay at the moment. But for me, if I was then in a position where my mortgage run out, I'd be talking, I think I looked the other day, I'd be nearly £700, £800 worse off. And that's an issue that a lot of people are going to be having in the next few months, the longer these interest rates stay high up. So the longer this stays high, that's going to be causing a problem. And that's one thing that I'm staring at, that we need these to start coming down to a reasonable level where people could be impacted, say that the mortgage payments go from 2% interest up to 3% or 4%. But if they're getting up to that higher end of 5-6%, that's obviously going to cause an issue. So that's, for me, a big thing to be looking at, because you're going to see income massively decrease, and what disposable income goes into the economy, that is obviously reduced. It also goes down to spare income that we just talked about, but companies' debt. There's so many companies at the moment that have been benefiting from having taken out money, especially non-profitable companies. In the last 12, 13, 14 years, you've basically been able to get free money. A lot of companies have been getting a debt at 1%, 2%, even 0. something percent. Companies have been getting basically free money. Now the problem is a lot of these companies that need to get money, or if they're having to refinance some of the debt, they've gone from getting that at 0, 1, 2%, and now it's going to be 5, 6, 7, 8. Up to maybe double figures. So for a lot of companies' point of view as well, that's going to be a tricky element for them to kind of battle over and get through it. So that's something to be staring out at, a lot of companies at the moment. Balance sheets are actually going to be really key now, and having not much debt on a balance sheet is going to be very important, I guess, in the next few months. So that's obviously something as well that's obviously going to affect a few companies, which you've got to be careful of. And the next thing that apart from interest rates is jobs. Jobs are key. We need to see people still employed. If people start losing their jobs, that's when you start going, okay, this is when things are going to start getting really bad. Because there's a difference between having your disposable or spare income reduced, and there's the situation where you haven't got any spare income, you've got no income. And you start seeing then mortgage defaults, loan defaults, and that's where the economy gets really messy. So obviously the way that you'd lose jobs is the economy deteriorates rapidly, and there's a lot less spending. Now that could actually be caused by the interest rates, so that's something to be really keep an eye on. In my opinion, we won't get a massive 2008 recession unless we see jobs, massive job losses out there. So that's something really key to be keeping an eye on, and I think that will be one of the main drivers going forward. At the moment, it all looks okay, and that's why I'm still pretty confident at the moment in the economy, but that's obviously something key that I'll be looking at. So those are the two main issues that I see in 2023 for the stock market in a recession. Is first of all the interest rates. I don't think they can stay at these levels for the full year, otherwise it will get quite messy. And also I think that would then move into like jobs. and if jobs start getting lost, unemployment goes up, that's then another major issue, I think. So those are the two key things that I stare at that will affect us next year. Last thing, just something that I want to mention though. Don't think this will be a problem in the next 12 months, but I've noticed buy now, pay later. I think that generally is such an unregulated area that seems to be growing at massive rates. The likes of Klarna, for example. I thought if one of these companies were ever to default or something happens to them, I thought that would be a major disruption now in the economy with the amount of people that are starting to rely on that platform. Not something that I thought in 2023 with the likes of a stock crash or recession, but for me this is an issue brewing in the background though that I'd be very careful of. Something that I'd be really staring at, because it does seem to be coming really popular at the moment, and there doesn't seem much regulation on it, and that's just something, in my opinion, that could potentially brew in the background for the next few years. And I just wanted to mention it very quickly on this video while we're talking about issues. That's something I would be staring at coming up in the future. So ignoring that anyway, for me, the two main issues are interest rates and jobs. I think if we see interest rates continue for 2023 and that starts affecting jobs, I think that's where we would enter a major recession and a stock crash that's worse than what we've had. If interest rates are reduced very quickly through 2023 because the inflation peaks and the jobs hold up to that time frame, I think we'll be all right. So that's what I personally think would cause a deteriorating economy, or a terrible economy in 2023, and a stock crash to get worse, in my opinion. So hope you enjoyed the video anyway, guys, and a few of you guys have asked about this video and my thoughts, so I hope you enjoy it, and catch you in a bit.